Hello friends, I welcome all of you to your own YouTube channel, World of Trade and Finance. So friends, in the last video, we discussed the basics of credit card, what is a credit card and what are the common terms that are associated with a credit card. In this video, we'll try to understand the calculation part of the credit card. So in the last video, we discussed the basics of credit card, like for example, what is the APR, the annual percentage rate, MPR, the monthly percentage rate, which is nothing but APR divided into 12 parts. What is the total amount due? What are the late payment charges? What is the minimum amount due, which is typically 5% of the total amount due? So friends, one of the major components of a credit card is the finance and the interest charges. So whenever you try to make a payment that is less than the total amount due, your credit card company levies certain finance or interest charges on your credit card. In this video, we will try to understand these interest charges. So friends, first let's try to understand when are interest charges applicable. So if the payment that you have made is the minimum amount due or a payment that is less than the total amount due or no payment has been made, then interest charges are applicable. So basically any payment which is less than the total amount due will attract interest charges. So how are interest charges calculated? So interest charges are primarily calculated on four parameters. The first is on the transactions in the previous statement from the respective transaction date till the statement date. Second is on the total amount outstanding from the statement date till the part payment date. Thirdly, it's on the remaining amount outstanding balance till the next statement date. And the fourth is on the fresh purchases done hereafter till the next statement date. I'll be taking 3-4 test cases that will help you understand these four parameters. So friends, let's first understand the formula that is needed to calculate the daily interest charges. So as I explained before, that APR is annual percentage rate, which is the annual interest at which your credit card company charges you if you are not paying the complete amount. And MPR is the APR that is divided into 12 parts. So interest calculated is nothing but interest outstanding into APR percentage into the number of days divided by 365. This is nothing but, for example, if you take the APR, so let's say if you have an outstanding amount and you try to take that APR as a percentage, so this will give you the annual interest. If you divide it by 365, which is the number of days in a year, that will give you the daily interest. And if you multiply that by the number of days, it will give you the interest that is needed, that is required for that duration of time. So if you replace APR by MPR, then it is nothing but the 12 times MPR. So both of these are essentially the same formula. So now to understand this, let us say if there's an outstanding amount of 1000 rupees and your credit card has an APR of 39%, then what would be the annual charges that would be levied on that 1000 rupees? That would be 39% of 1000 rupees, which is 390 rupees. And the daily charges would be 390 divided by 365, the number of days in a year, which would be 1.07. And if you wanted to calculate it for 30 days, it would be 1.07 into 30 days, which would be 32.1 rupees. So friends, to understand the interest charges, let's take 3 to 4 test cases. So let's take the first case where full payment has been made. So to understand it, let us assume that you have a credit card which has an APR of 39% and an MPR of 3.25%, which is nothing but 39% divided by 12. So let's try to understand the statement using this test case. So let us say you have done a transaction, you have done some shopping on 25th of July for 10,000 rupees. Your statement or the bill date is on the 1st of August and the due date or the last date of payment of that statement is on 28th of August. So now your total amount due becomes the total transaction, assuming that this is the only transaction, which is 10,000 rupees. The minimum amount due would be 5% of the total amount due, which is 500 rupees. On the 15th of August, you have made a payment of 10,000 rupees, even though your due date was 20th, but you could always pay before. So on the 15th of August, you made the full payment of 10,000 rupees. And after that, on the 25th of August, you did another transaction you did another shopping of 15,000 rupees, and the new statement comes on the 1st of September. So now your total amount due would only be this transaction, which is 15,000 rupees. Minimum amount due would be 5% of the total amount due, which would be 750 rupees, and there would be no interest charges levied on your card, simply because your total amount due for your previous statement was 10,000 rupees and you made the complete payment of 10,000 rupees. Therefore, no interest charges would be applicable for this month. It doesn't matter you did a later transaction of 15,000 rupees, because once you have paid the complete bill of the past month, any transaction that you do will not attract any interest charges. So friends, now let's take another case in which no payment has been made. So let's say for the same credit card, let's consider this statement. So let's say on the 25th of July, you have done a shopping of 1000 rupees, and the statement for this credit card comes on the 1st of every month. So the statement comes on the 1st of August. So your total amount due is 1000 rupees. And the due date for this payment is 20th of August, which is nothing but the last date of payment. Let's say no payment was made. So I have not even paid the minimum amount due. So once the new statement comes on the 1st of September, the outstanding would be 1000 rupees because nothing was paid, plus the late payment charges. So late payment charges are levied only when you are paying nothing or you are paying an amount which is less than the minimum amount due. So let us assume that the late payment charges for this range is, let's say, 400 rupees. So now let's calculate the daily interest that has been incurred on this 1000 rupees, which is nothing but the APR or the MPR into 12, which is the annual charges, into 1000 rupees, which is the outstanding, divided by 365, the number of days in a year, which would give you the daily interest charges. So now this interest is levied on 38 days. How is this 38 days coming? Is that the interest is levied from the date of transaction, which is 25th July, till the date the new statement is made. So this interest will be levied from the date 25th July, the date of transaction, till the new statement date, which is 25th July to 1st September, which would be 38 days. So the interest that would be levied would be the daily interest rate 1.07 into 38, which is 40.66. Other than this, even GST is added at the rate of 18%. And GST is also calculated on the late payment charges. So GST would be 18% of late payment charges plus the interest that has been accrued in 38 days, which is 79.32. So the total payable would be total outstanding 1000 rupees plus the late payment charges 400 plus the interest 40.66 plus the GST component 79.32, which is 1519.08 rupees. So friends, let's consider the third case when only the minimum amount due has been paid. So for the same credit card, let us understand this transaction. So let us say you have done some shopping on the 25th of July. You love shopping for 1000 rupees. The bill date of that credit card comes on the 1st of every month. So the bill date comes on the 1st. The due date is 20th August. So the total amount due is 1000 rupees, assuming this is the only transaction. The minimum amount due is 100 rupees. Well, as per calculation, the minimum amount due should have been 5% of 1000, which is 50 rupees. But most credit card companies charge 100 rupees as the minimum due amount. So it would be 100 rupees. Now let us say you made a partial payment. You paid only the minimum amount due on the 11th of August of 100 rupees. So when the next bill comes, what are the charges that are going to be levied? First, late payment charges. There will be no late payment charges because, as I explained earlier, late payment charges are only levied if you are paying less than the minimum amount due or you are paying nothing. So there are no late payment charges. The outstanding balance would be 900 because the outstanding balance in the previous statement was 1000 rupees and 100 rupees was paid. So the outstanding balance carried in the next statement would be 900 rupees. Now there would be two types of finance charges that would be applicable here. Since the complete amount was not paid, so this transaction that was done in the previous month would carry an interest of the APR or the MPR into 12. So APR divided by 365 would give you the daily interest on the total outstanding, which is 1000 rupees into 17 days. How is this 17 days coming from? The 17 days is coming from the date of transaction, which is 25th July, till the date of the part payment. So the interest is levied on the complete amount, that is 1000 rupees, from the date of transaction 25th July till the date of part payment, which is 11th August. This difference is of 17 days. Therefore, the first finance charges would be 18.16 rupees. The second finance charges would be on the remaining outstanding amount on 900 rupees from the part payment date till the next bill date, which is the part payment date 11th August till the next bill date 1st of September, which is 21 days. So this finance charges would be 20.19 rupees. GST would be applicable at 18% of both the finance charges, which is 18% of 18.16 plus 20.19, which is 6.90. So therefore the total amount payable in the next statement would be the outstanding balance 900 rupees plus finance charges 1 plus finance charges 2 plus the GST component, which is equal to 945 rupees 26 paise. So friends, let's consider the fourth case where the full payment is not done. Also, a fresh purchase has been made post the partial payment. So for the same card, let us consider this sheet. So let's say a shopping transaction has been done, as you love shopping, on the 2nd of June for 5,000 rupees. On the 14th of June, another transaction of grocery has happened for 1000 rupees. The statement date is on 20th of June. So the total amount due would be 5000 plus 1000, 6000 rupees. And the minimum amount due would be 5% of the total amount due, which is 300 rupees. Now let us say you have made a payment on the 10th of July for 1000 rupees. And on the 14th of July, another transaction, a fresh purchase of grocery was done on the 14th of July for 1000 rupees. Now, once the next statement comes, what are the charges that are going to be levied on your credit card? Late payment charges, there would be no late payment charges because the payment that was made is greater than or equal to the minimum amount due. So there would be no late payment charges. What would be the outstanding balance? The outstanding balance would be the total amount due for the last transaction, 6000 rupees, and the payment that was made, 1000 rupees, which would be 5000 rupees. So there would be four types of finance charges that would be applicable on this transaction. The first one would be on the old spend. So there are two old spends, 5000 and 1000. So let us consider the first old spend here. So on 5000 rupees, considering the APR, which is 39%, or the MPR 3.25 into 12 divided by 365 into 38 days. This 38 days is coming from the date of transaction till the date of part payment, which is from 2nd June to the 10th of July. So it would be levied on 38 days, which would be 203.01 rupees. The second finance charge on the old spend would be on this 1000 rupees, which would be the same formula into 26 days. This 26 days is coming from the date of transaction, which is 14th June, till the date of the part payment, which is 10th of July, which is 26 days. So that is 27.78 rupees. The third finance charge would be on the outstanding. So the outstanding is 5000 rupees. On the outstanding, applying the same formula, we would be incurring the interest for 11 days. This 11 days is coming from the part payment date, which is 10th of July, till the new statement date, which is 20th of July. This is 11 days. So you would incur an interest on 11 days on the new outstanding, which is 58.77. And there would also be an interest levied on the fresh spend of 1000 rupees, which was done on the 14th of July. Using the same formula, this would be incurred for 7 days, which is the day of spend, 14th of July, till the new statement date, which is 20th of July. So for 7 days, it will be 7.47 rupees. GST would be 18% of all the four finance charges, which would be 53.47 rupees. So the total payable in the next statement would be 5000, which was the outstanding balance, plus 1000, which is the fresh purchase, plus the four charges, which we have calculated here, plus the GST component, which would be 6350.51. So friends, that's all in this video. In this video, I only wanted to explain the finance charges that are incurred in credit cards using 3 or 4 test cases, which would be when there is full payment, when there is no payment, when there is just a minimum amount due payment, and when there is a partial payment along with a first purchase. So friends, if you have liked this video, I request you to like the video, subscribe to my channel, comment on the video, share it with your friends and family. I'll be posting more videos on similar topics. So stay tuned. Take care. Goodbye.